Derek Mazzarella here with Gateway Financial Partners. We have another segment of Ask Derek. The demand has been through the roof. So let's get started with the questions. The first question I got is, how do I begin investing? This is a great question. A lot of people may be intimidated on how to start. So I was going to use my son's Lego block set to help explain how to get started with investing. So when we go on the internet, we see basically this information about what to invest in. You may hear, just invest in an S&P 500 index fund, or invest in this mutual fund, invest in that. But what's really right for you? Most people are going to fall in the same category, but I always try and use basically a seesaw analogy to explain how to invest. Typically, if people have all their money in one investment or one type of asset class, you'll see these huge swings with your portfolio. What we want to do is try and balance this out so over time you have a much smoother ride. So let me talk about this. So the first investment you really want to have, and you want to have be the core of your portfolio, is going to be an S&P 500 index or large U.S. company stocks. They tend to be the most consistent performers, and they do pretty well in terms of return over time. So that'll be your base. Now on top of the seesaw, we're going to have a bunch of different asset classes because we want to level out the seesaw. So for example, you're going to have some U.S. Small cap. You may have a little bit of emerging markets, overseas countries. You're going to have some developed markets. You want to maybe have some real estate. So at the end of the day, you have this portfolio that is going to be a little more even, is not going to be as volatile. So you want to have a diverse portfolio of a lot of different asset classes to help give you a more consistent return over time. All right, so next question I have is going to be, I have a good amount of company stock. What should I do with it? So this is a common problem that I see pretty frequently. Typically what happens is, let's say you have stock options or a company gives you restricted stock units or any kind of stock compensation. What I typically see, and let's go back to our seesaw analogy, is the company stock tends to just build up and build up and build up over time. Inevitably, it becomes a much larger piece of your portfolio, and you don't have a very level seesaw. So what we want to do is, over time, we'll take some of that stock and divest it into other asset classes. Because what you want to go back to is have that nice seesaw that's level again. So typically, I recommend you keep between 10 and 20% of your company stock, and then offset and sell the rest. Derek Mazzarella with Gateway Financial Partners. If you have any other questions financially, please feel free to reach out. You can always email more questions at dmazzarella@mygfpartner.com.